Weighing on investors today. Concerns about what was likely to happen after that weak Wall Street close on Friday. US earnings are really weighing.
James, no doubt that weak lead from the US did impact on our markets, but our market's not falling as much as the US. We saw a fall of 0.7% and things really did improve throughout the day. We did see all sectors lower, and it was quite funny having a look at the sectors. There was really no clear trends on the market. Today we saw both the low beta as well as the high beta areas being sold off. In fact, the worst areas were the material space and as well as the healthcare and the telecom space. Staples was the best area, helped along by Grain Corp, which was up by massive 39% today, and the selling seemed to be on the big end of town. We saw the ASX 20 one of the worst performers. In fact, if we have a look at some of the blue chips around the market, we saw Rio Tinto down by 2.4%, AMP lost almost 2%, and we also saw QBE Insurance down by almost 2%. In fact, if we have a look at the mid-cap and the small-cap space, faring much better than the blue chips. We saw the mid-cap index down by 0.3% and the small-cap index down by 0.4%. So it really looks like our market is simply following off those weaker leads from the US. As you mentioned, James, earnings coming in weaker than expected. We heard from the likes of Microsoft after hours, and that wasn't as good as what the market was expecting. And we also saw McDonald's coming in weaker than expected. We saw a stronger US dollar, and that, of course, had a negative impact on the commodities part of our market, but all up some light volumes. It looks like selling across the board, and mostly the steepest falls being on the big end of town.
Is maybe, though, a limit to the level of risk tolerance that we might see, continued pushes into the equities, but it's going to be very strategic and it could continue to be in that safer sort of yield play.
I absolutely agree that it's been a fantastic run-up since the 1st of June. But as you have a look at the sectors, it is particular sectors which stand out. In fact, the material space has really lagged in terms of performance, looking pretty flat since the beginning of June. And instead, it's been the banks as well as those defensive areas which have really powered along our market. We have a look at the banks. The Commonwealth Bank's up by 15% since the 1st of June. The other three banks are up between around about 20 to 30%. So some extremely strong gains there for a sector which is seeing quite anemic earnings growth, and we're starting to see broker downgrades in this space now with the banks running quite hard. The telecom, the utilities, the healthcare sectors, these are all areas which have done relatively well as well. So it's been quite strange, this rally that we've seen from the Australian share market. We're usually used to those high beta growth areas powering along our market, but instead it has been the high yielding defensive area which has really outperformed. So it's been fantastic for the Australian share market, but you do need to have been exposed to the right sectors, because it's been the materials, the energy space which has underperformed in this rally, and instead it's been those defensive high yielding players which have really outperformed.
Look, Julia, one of the big stories obviously today, the mid-year economic update, the budget update if you like, and it's a story we're going to continue, a theme we're going to continue throughout market day today. But wanted to get your thoughts in terms of, was there much market reaction on equities?
I think the biggest reaction was in the healthcare space, and the healthcare space was one of the worst performing on the market today. Usually you expect this area to be one of the best performing areas and an area of outperformance when you do see a risk-off day like today. But we did see healthcare being sold off quite severely, and I think that was on the back of this review. What we saw was about $700 million worth of cuts to the private health insurance area. Now, they will take a while to kick in, so it will be from FY14 onwards, but we did see an impact in terms of the healthcare players. We have a look at some of the private health insurers. We did see NIB, the stock code there, NHF, down by about 0.8%. In fact, NIB coming out and releasing a statement saying that they don't expect a significant impact to the industry or to their particular business, and these cuts were well flagged and that they are quite a way off in FY14 onwards. So we did see NHF actually paring back some of those losses, but we also saw losses in the likes of primary healthcare, which was down by 2.8%. Sonic was also down by 0.9%. Some other major changes also in terms of the ways companies pay tax on a monthly instead of a quarterly basis, and also to the baby bonus. But I think it was the healthcare sector where we saw the biggest impacts of that review today.